We are about to discuss a topic from capital gains right now. It is called as slump sale. That is the next topic that we have to discuss. So listen. First of all, you should understand what is the concept of slump sale. Okay, let's understand what is the concept of slump sale. So the slump sale is actually, this 50B topic is actually a topic which is exclusively applicable for CA final. 50B is there for your inter, but there are certain valuation rules that they have inserted as a part of section 50B. These valuation rules are there only for final syllabus. Let's understand what is this slump sale. So friends, as you all know, a particular income will be taxable under the head capital gain if there should be a capital asset. If there is a capital asset and there is a transfer of capital asset. Transfer of capital asset. Then as you all know, if there is a capital asset and there is a transfer of capital asset, then the transfer is subjected to what? Capital gains. Now friends, listen. Imagine, say I am a company JK Limited. I have a particular unit where I have lots of assets. Say 100 assets are there. And I have around 70 liabilities. Not 70, say 30 liabilities. 100 assets and 30 liabilities. 100 means not the value, it's the count. Okay. There are 100 assets and around 30-40 liabilities. I am transferring this entire business for a lump sum consideration to another person. I am transferring this entire business for lump sum consideration to another person. Are you with me? Now there are certain problems. How many capital assets are there? 100 capital assets are there. Are you with me? And you need to compute 100 set of capital gains over there. And there can be one more problem. What is that problem? The consideration is what? We don't know for each asset what exactly is the consideration. We only got a lump sum consideration. So due to this two problem, what department say, don't worry, we have a solution. What is the solution? You treat that entire business unit as one single asset. You treat that entire business unit as one single asset. Then you transfer that entire business unit. You consider it as a single assets transfer. You compute the capital gain in accordance with section 50B. You compute the capital gain in accordance with section 50B. And that is what we are about to discuss right now. Are you all here? So let's understand what exactly is the meaning of slump sale. So slump sale means transfer of one or more undertaking for a lump sum consideration without assigning values to the individual assets and liabilities. If you are transferring your entire unit or a business undertaking for a lump sum consideration without considering value for the individual assets and liabilities, then we call it as what? Slump sale. Are you all here? So I'll read the definition again. Slump sale means the transfer of one or more undertaking for a lump sum consideration without assigning values to the individual assets and liability in such sales. Now, not yet over. Now, as I've told you, this entire business undertaking is considered as one single asset. Now, how do we check whether this asset is long-term capital asset or short-term capital asset? Department say, it normally the period of holding of the asset is the criteria for determining whether it is long or short. So here what department say, if that undertaking is held for more than 36 months, then that entire undertaking have to be treated as long-term capital asset. You are running that undertaking and that running, you held it for more than 36 months, irrespective of date of transfer. Whether it is after 23rd July 2024 or before 23rd July 2024, doesn't matter. The period of holding over here is 36 only. Are you here? So to check whether the asset is a long-term capital asset or a short-term capital asset, it depends upon the period of holding. And that is undertaking, whether it is held for more than 36 months, then it will be a long-term capital asset. Otherwise, it will be a short-term capital asset. That means if the undertaking is held for less than or equal to 36 months, it will be a short-term capital asset. Now, tell me friends, how do we normally compute the cost of acquisition? What is the normal cost of acquisition? Normal cost of acquisition means the purchase price of an asset. Yes or no? But in slump sale, what department say, it is not the purchase price because it is the business undertaking. So you compute the net worth. You compute the net worth of the undertaking or the division as the case may be, and it shall be deemed to be the cost of acquisition rather than the purchase price. We will not be having a purchase price for the undertaking. Yes or no? So maybe we might ourselves have started that undertaking and purchase assets, incurred liability at different point of time. So what department say, don't worry, in such a case, you compute the net worth of that undertaking as prescribed by us. That net worth can be considered as what? Cost of acquisition. That net worth can be considered as the cost of acquisition. From that cost of acquisition, you are not supposed to claim the benefit of indexation. You cannot claim the benefit of indexation. That's what the department says. From the cost of acquisition, you are not supposed to claim the benefit of indexation. And let's understand this one by one. So we understood what is slump sale, and we understood how do we determine whether it is a long-term or short-term capital asset. The third one, the cost of acquisition as well. Now friends, listen. So how do you compute the capital gains? So capital gains. Correct the spelling, okay? Capital gains. Let's compute the capital gains, friends. Listen. The full value consideration. We always initially requires full value consideration. What is the format for computing capital gain? Full value consideration minus direct expenses will give you net sale consideration. From the net sale consideration, you deduct cost of acquisition or cost of improvement. Then you will get long-term or short-term capital gain. Are you with me? So here, what might be the full value consideration? You will say the lump sum amount that I have received shall be normally the full value consideration. Yes or no? When I am selling my undertaking for a lump sum consideration to someone else, whatever the lump sum consideration that person paid shall be deemed to be the full value consideration. That should be the full value consideration normally. Are you all here? But here what department say, it is not like that. Then how do we compute the full value consideration? What department say is, you take the fair market value in the prescribed manner. And what is the prescribed manner? For that, fair market value 1, you have to compute as per rule number 11 UAE sub rule number 2, or fair market value 2 have to be computed in accordance with rule number 11 UAE sub rule number 3, whichever is higher. In simple terms, we can say you first compute FMV 1, then you compute FMV 2 and pick the higher. What is the FMV 1? It is the fair market value of the assets that you transfer to another entity. Are you with me? What is FMV 1? The fair market value of the assets that you are transferring to another entity is said to be FMV 1. And what is FMV 2? The fair market value of the consideration received. If the consideration only in money, then you take the money value. If that along with the money they have given some gold, then you take the fair market value of the gold as well as the money value. If along with the money and gold they have given a land also, then you take the valuation of the land. So in this manner, first you compute the fair market value of the assets that you have transferred. That is FMV 1. Then you compute the fair market value of the consideration that you have received. That is FMV 2. Then you pick the higher. Normally it have to be equal. Yes or no? That's how you value your business. Yes or no? Whatever the fair market value of my assets shall be the consideration that I have received. If something is more, then you have to consider that higher value as the full value consideration. Are you all here? Now the question is, how do we compute FMV1? That is what we are supposed to study in our final syllabus. Listen, FMV1 equal to fair market value of the capital assets transferred by way of slump sale, determined in accordance with the formula, that is A plus B plus C plus D minus L. All the CBDT formulas are like this. Okay, they will put A plus B plus C plus D minus L. L is liability. I don't know why they have given L for liability. Normally, according to the custom, CBDT usually say A, B, C, D minus E, because the next letter comes after D is E. But here, lot of hard work they have done. For liability, they have written L. Wow. So, from jokes apart, the point is A plus B plus C plus D minus L. First, you start with B. What is B? open market price of the jewelry and artistic work. Imagine, say this is a company. Okay, this is a company. I'm transferring this company to someone. When I'm transferring this company, for computing the full value consideration, the first thing that I'm supposed to compute is FMV1. How do I compute FMV1? I go verify the balance sheet asset side. In the balance sheet asset side, if there is jewelry or artistic work, then what should be the value? Fair market value of that jewelry or artistic work, based on the valuation report obtained from the registered valuer. Whatever the fair market value that has been given based on the valuation report submitted by a registered valuer. That is point number B. Then what is C? Fair market value of shares and securities. Do you remember in exit taxation we have already valued shares and securities? Listed share, average of highest and lower price. Unlisted share, open the balance sheet of that company, then you compute the net worth divided by PV into PE. Do you remember that? Are you all here? So, the same valuation principle you have to make use of for valuing shares and securities. Are you all with me? So, in the case of a shares and securities, you need to compute the fair market value of those shares and securities. Then, next one. Say the next asset is an immobile property. Then what value? Stamp duty value. If your balance sheet have some immobile property, then you should take stamp duty value. So we have B, C and D. Then what will be A? For all other assets, you take the book value excluding these two assets. While computing the FMB1, you can ignore these two assets. What is number one? Any amount of income tax paid less by income tax refund. Say for example TDS, TCS, advance tax, etc. Net off by the refund. If it is there in the balance sheet side, ignore. Why? I cannot transfer TDS, TCS, advance tax, etc. to someone else. I only can get a refund. So ignore that value of asset. Number two, unamortized value of deferred expenditure. Hope you remember in trust itself we have seen points like this. Unamortized value of deferred expenditure means it is my historical cost. Only for accounting terminology, I have shown it in my balance sheet. I cannot technically sell that asset. So, apart from these two assets, take the book value of all other assets. Can you tell me an example for any other asset? Stock in trade, debtors, cash, bank, etc. What value? Book value. Plant and machinery. What value? Book value. Are you all with me? So, these are the four things that you have to consider over here. So, in the balance sheet side, if there is number one, jewelry and artistic work, FMV. If there is shares and security, then we know how to value the share and security. If there is immobile property, SDV. All other assets, book value. Except income tax as well as unamortized value of deferred revenue expenditure. Bus, A plus, B plus, C plus, D we have. Now we want L. What is L? Liability. You tell me how do we value liability? You take the book value of all the liability excluding. When you take the liability, you are not supposed to take the following liabilities. Which all are the liabilities that you are supposed to exclude? Let's see. Number one, paid up equity shares. Obviously, that is not your outside liability. So, you are not supposed to take equity share capital. An amount set apart for paying dividend on preference as well as equity shares. If there is some amount that you have set apart for paying dividend, either it for equity shareholders or preference shareholders, that also have to be excluded. Reserves and surplus have to be excluded. Amount representing provision for taxation have to be excluded. Unassigned liability have to be excluded. Representing contingent liabilities also have to be excluded. So 1, 2, 3, 4, 5, 6. 6 types of liability you have to exclude. Apart from this 6, whatever liability you have is said to be what, friends? L. According to our formula, apart from this 1, 2, 3, 4, 5, 6 liability, all other liabilities book value is said to be what? L. Are you all here? You tell me which all are the liabilities that we have to exclude. Equity share, then amount set apart for paying dividends, reserves and surplus, provision for taxation, unascertained liability, contingent liability. Excluding this, whatever liability you have, say bank loan, book value. Creditors, book value. Are you all here? Bills payable, book value. So all this you have to take the book value. That's what they are saying. So we got A plus B plus C plus D minus L, and that is FMV 1. That is the net worth or fair market value of the net assets that we have transferred. That is FMV 1. Now we need to compute FMV 2. Okay, what is FMV 2? It is the fair market value of the consideration received or accruing as a result of transfer by way of slump sale. So during the slump sale, whatever is the consideration that you have received, that entire consideration's total value is said to be FMV 2. First of all, you tell me what is the formula? E plus F plus G plus H. Till D they have used over there. Now the remaining alphabets they have is E, F, G, H. Are you with me? So what is E? When you hear E, E has no connection with word E. That is monetary consideration. E should be what? Monetary consideration. Don't ask me how do we value monetary consideration. How do we value monetary consideration? Monetary consideration already have a value. Now there is no valuation rule for valuing monetary consideration. If it is 1,000 rupees, then value is 1,000. You don't have to put any tough valuation principle over there. Okay. Second one, if it is shares and security, same. What? Listed, then highest and lower price on RSC, unlisted, balance sheet net worth divided by PE into PV. Then, if it is immobile property, stamp duty value. If in the case of any other assets, you take the open market value, like gold, jewelry, etc. If you are getting, you take the open market value. Are you all here? Point is very simple. How do we value? You take the, if it is monetary consideration, consider that value. If it is shares and security, then we have already valued it. Listed share, highest and lowest price average. Unlisted share, you compute the net worth of that respective company, then divided by total paid up value of equity shares that they have issued into total paid up capital of equity shares that we are holding. Then immobile property, STV. Any other asset, open market price, like gold, jewelry, etc. If you are getting, you take the open market price. So now we are getting FMV2. Now which one to pick higher? FMV1 or FMV2, whichever is higher. That's how you have to consider. Are you all with me? So now we are getting what? Full value consideration. So what is full value consideration? FMV1, FMV2, whichever is higher. Now we require direct expenses on transfer. How do we compute direct expenses on transfer? As usual. Don't consider as usual minus normal brokerage divided by commission. It is not that. As usual means normal brokerage or commission. Are you with me? So when you technically read, it is as usual minus normal brokerage by commission. Okay, that's what he taught us. I don't know what it is. It's not like that. As usual means either normal brokerage or commission. Okay. Now, next is cost of acquisition. How do we compute the cost of acquisition? Net worth computed in prescribed manner is said to be the cost of acquisition, and from that net worth you cannot claim the benefit of indexation. That too, 23rd July 2024, nobody can claim depreciation on anything. Only for individuals and HUF they can claim indexation. Okay, for all other assessees, indexation is only a dream after 23rd July 2024. Hence, we don't have to highlight this. You know that it is gone. Even before 23rd July 2024, you will not be getting indexation on slump sale, because while computing slump sale, nobody is supposed to claim indexation. Whether it is before 23rd July 2024 or after 23rd July 2024, doesn't make any difference. Moving on. So where were we? We were cost of acquisition. So how do we compute the cost of acquisition? You take the net worth in, which is computed in prescribed manner. How do we compute net worth of a company? Tell me, how do we compute net worth of the company? Department, what they are saying is you compute the total value of assets. You take the total value of assets minus outside liabilities. Outside liability means book value of outside liability. You need to compute the total value of assets minus book value of outside liability. How do we compute total value of assets? For that, we have to divide that asset into 4. We have to divide that asset into what? 4. Number 1, first category of asset. Let's understand what exactly is the first category of asset. Department say depreciable assets. Department say what, friends? Depreciable assets. If it is depreciable asset, then what value? WDV value. If in the balance sheet you have depreciable assets, you always have to consider WDV value. Second type of asset where 100% deduction is already claimed. What is that? Scientific research asset, 35 AD asset, something like that. Already we have claimed 100% deduction, then nil value. You are not supposed to take any value. Why nil value? Because we are computing cost. We have already claimed its entire cost already as a deduction. Now again, you are not supposed to take any value as a deduction. So net worth is basically the cost. So already you have claimed 100% deduction. While computing the net worth, which contributes to the cost, you are not supposed to take any value. Third one, self-generated goodwill. Self-generated goodwill. What is self-generated goodwill? You yourself started a brand and you yourself promoted a goodwill. For that, you are not incurring any separate cost. You do good business, automatically you will be having that goodwill. So now you are doing good business, automatically you will get a better brand name. So self-generated goodwills, what would be the value? Nil value. It shouldn't be any value. For all other assets, what value? Book value. Say for example, plant and machinery being depreciable asset, WDV value. Scientific research asset, 0 value. Goodwill, my own brand, 0 value. Debtors, book value, because it is other assets. Land, book value, because here it is other assets. Are you with the non-depreciable asset? Are you with me? Now, while valuing the assets, one thing you have to be careful. If any of the assets have been revalued, then there can be an increase in value. Yes or no? Say land. Land's value have been already revalued. So there can be an increase in the book value. That you have to ignore. Then you have to bring it to its original cost. You are not supposed to consider the effect of revaluation while computing the net worth in slump sale. You are not supposed to consider the effect of revaluation while computing slump sale. That's what department says. Are you all here? So let's go back to the theory, friends. Net worth computed in prescribed manner. How do you compute net worth? Aggregate value of total assets of the undertaking or division. There is a value of outside liability of undertaking or division as appearing in the books of accounts. However, any change in the value of asset on account of revaluation of asset shall not be considered for this purpose. Now, in the case of depreciable asset, WDV value as per IT Act. Capital asset, 100% reduction is claimed, nil value. Self-generated goodwill or business, nil value. All other assets, book value. Outside liability, book value. Outside liability, that means share capital and reserves don't pick. We're only talking about outside liabilities. This is it. There is no cost of improvement in slump sale because we are computing the net worth. There is nothing called a cost of improvement while computing the slump sale. And one more thing is there. Report of a CA. Every assessee in the case of a slump sale shall furnish in prescribed form a report of a chartered accountant on or before due date under 44 AB, that is 1 month prior to the due date of filing your return of income, indicating the computation of net worth of the undertaking. You yourself don't have to compute the net worth. You have to submit a report of a chartered accountant. Chartered accountant have to certify your net worth. Then only we will accept that amount as your net worth. Otherwise, we will not accept that particular amount as your net worth. Are you with me? So I hope that point is clear for you. All good. So friends, we were discussing about what slump sale, and I hope this much is clear for you. So based on this, let's solve some questions. So I want all of you to take the question sheet. So friends, this is your question sheet part 1. Question sheet part 1, page number 20, question number 6. Sheet 1, Page 20, question number 6. Please take this question and give me the answer. It's a fantastic question. So that was question number 6. I'll read question number 6 from here and let's solve the answer together. So that question is connected to or connected with the concept of slum sale. So Mr. Sriram or Messrs. Sriram Enterprises, a proprietorship having 2 units, unit 1 transferred on 1st April 2024 by way of slum sale for a total consideration of 14 lakhs. Unit 1 was started in the year 2006-2007 and the expenses incurred for this transfer were 38,000. So for that transfer they have incurred an expenditure of around 38,000. The balance sheet as on 31st March 2024 is as under. So the balance sheet is also given here under. So on capital revaluation reserve, lot of informations are there. Now other information, revaluation reserve is created by revising upward the value of building of unit 1. Stamp duty value of building as on 1st April 2024 is 10 lakh. No individual value of asset is considered in the transfer deed. The patents were acquired on 1st July 2022 on which no depreciation has been charged. Compute the capital gain for assessment year 24-25. So they are asking you to compute the capital gain. So they have transferred that under us by way of a slum sale. So that is very much evident. So the first thing that you have to compute is FMV1. So we'll be computing FMV1 first. How do we compute FMV1? You take the balance sheet assets first. The first asset is building. Building, what value you have to consider? It is the stamp duty value. FMV1, while computing FMV1, you have to take the SDV, that is 10 lakh in this question, okay? It should be 10 lakh. Then the second value that we have to consider is machinery. Again, we can take the book value. No other value available, 4 lakh. Debtors, obviously, book value, 2 lakh. Patent, obviously, whatever the value given in the books that you can take, 2 lakh 50. Now, bank loan, total value of assets. Can you tell me the total value of assets? 1850. Now, bank loan is there. For that, you have to take the book value. 70% on 4 lakh, that will be 2 lakh 80,000. Then you have creditors, 25% of 3 lakh 50,000. How much is that? 87,500. You deduct that, how much will be the FMB1? 14 lakh 82,500. Now we will compute the FMV2. So what they are saying is they are only giving monetary consideration of 14 lakh. So that amount can be taken as FMV2. So whichever is higher means FMV1. So full value consideration shall be 14 lakh 82,500. Are you with me? Now, is there any direct expenses on transfer? Yes. They spend around 38,000 as the direct expenses on transfer. So can you tell me how much is the net sale consideration? 1444,500. Then how about the cost of acquisition? We need to compute the net worth. We will do a working note for that. Okay, working note 1. Net worth. How do we compute the net worth, friends? For computation of net worth, say we will have to value the assets first. Building. Building being a depreciable asset, but they are not saying any other information in the question. We don't know whether the 13 lakh is WDV value or something, but one thing is there. They are saying that revaluation reserve is created by revaluing the building upwards. So one thing is there. In that 13 lakh, there is a revaluation effect is coming, and how much is that? 5 lakh. Hence the original value of the building is only 8 lakh. We are assuming it as the WDV value, being building a depreciable asset. Since we don't have any other information in the question, we are assuming that it is a WDV value. Plant and machinery, again, we are assuming that 4 lakh as a WDV value. Then debtors, the 2 lakh. Patent, but patent, one thing is clear. They purchased patent on 1st July 2022. They purchased the patent on 1st July 2022. And what is the purchase price? 2,50,000. Now, but they haven't charged any depreciation till now. So this 2,50,000 is not WDV value. You need to remove the effect of depreciation. So for 22-23, there is depreciation at 25%. Patent being an intangible asset, the rate of depreciation is at 25%. How much is 25% on 2,50,000? 62,500. How much is the remaining value? 1,87,500. Now, one more year is there because slump sale happened in 1st April 2024. So, one more year's depreciation you have to remove. How much is 23-24's depreciation? Another 25% on this. 46,875. Can you tell me how much is the 1,40,625? That's it. Now, can you take the total of the assets for the computation of net worth? 15 lakh 40,625. 8 lakh plus 4 lakh plus 2 lakh plus 1.40625. So now we have liabilities. Liability we can take same book value itself. Bank loan is there 2,80,000. Then creditors are there, that is 87,500. Deduct these two, how much will be the remaining value? 125, 1173, 125. That is the cost of acquisition, 1173, 125. Can you claim the benefit of indexation? No. Tell me how much is the long-term capital gain? How can I make sure that it is a long-term capital gain? See, because they are saying that it is started in the year 2006-2007. So it is anyways more than 10 years. And hence, we can say that is a long-term capital asset because the period of holding, the period that undertaking have to be held by the assessee for more than 36 months. So, can you tell me the figure? 271,375 shall be the long-term capital gain, and that is the final answer to the question, and I hope it is clear for you. Hello my dear ones, this is CA Jose Kurian, and this video is to inform you about how to purchase our recorded lectures and textbooks from the website. Very simple, you log on to www.cajosekurian.com. And in the website, you scroll down and you can see all our books. That is handbook multicolor for CA, CMA final as well as for inter. Then we have workbook which contains past exam 30 plus question papers as well as RTPs. That is also for CA final, CMA final and CA as well as CMA inter. Now for the recorded lectures, you go up, take the website, then click on the classroom. And in the classroom, you can scroll down and you can see all the courses that we are offering. Select your course, make payment, and the course is all yours. It is instant access. Now, what are the courses that we are offering? We are offering CA Final English as well as Malayalam, CMA Final English as well as Malayalam, CA Inter English as well as Malayalam. Now friends, what are you waiting for? Get your access today and unlock the pathway to your success. All the very best. Take care and bye-bye.